So he bought the shares of LNG a month or a little while ago, had made some other adjustments. The stock had moved up above 47. Actually, about 4 days ago, it was trading above $48 per share before pulling back. Now, Sheldon's question was he had sold a November 47.5 call and bought, same expiration, November 17th, 47.5 put. That's sort of a collar, but with a twist. He wanted to know if this was a good trade. Okay, well, let's take a look at that. The LNG position, the shares with a cost basis of $43.50. When I looked today, the stock was trading around $46.11. And as I mentioned, it was higher at 48. So right now he's sitting on an unrealized gain of $2.61, roughly about 6%. Now the structure created was a collar, but when you create a collar where the call and the put strike are the same strike and have the same expiration date, it's actually called a conversion. Okay? And a conversion will sort of yield a straight line profit and loss chart. So anytime you sell a call and buy a put in a collar format, but you put it at the same expiration and the same strike, you're going to create a conversion. So let's say on or around October 17th, earlier this week, with his cost basis of $43.50, Sheldon had sold a 47.5 call for $1.70 roughly. And at the same time, he bought the November 17th standard expiration 47.5 put for $1.25. The total net credit was 45 cents. So he's going to lower his cost basis down to $43.05 with a potential to get 47.5 back. So he has a guaranteed profit of $4.45 or 10.3% no matter what happens next. That's the power of the conversion, but it also has a limitation. Here is the straight line profit and loss chart for the conversion. I don't want to use that color. Bad color to use. We'll go back to green. Okay. So here, the straight line profit and loss chart for this conversion means that if the stock stays above 47.50, he'll get a sign on the short call, the put expires worthless, and he'll make $445 or 10.3%. If the stock falls, drops to $42.50 or $40 per share, the call will expire worthless that he sold, and he can exercise the put to force someone to buy his shares of stock at $47.50. With a cost basis again of $43.05, he gets $445, a negative at-risk guaranteed profit of 10.3%. So no matter what happens, he can make 10.3% on this position to November expiration. A conversion gives you a straight line profit and loss chart, and there is a reversal of that. It's just simply called reversal. If you're short stock and you do the short collar but use the same strike price, that would be called a reversal. So it's the same if you're assigned to the upside or you exercise the put to the downside, but it's no chance for further upside without management. Okay? So the question is this a good trade? Well, it's a good trade if the guaranteed return matches your goals for the position. We could generate almost another 4.3% from where we are now. Of course, remember, he did this back when the stock was around 47, 47.50. It was a little bit higher in price. So right now we could liquidate for 6%. At that time, it was probably closer to 8%, but he was able to lock in about another 2% on the position or so, 1.5%, by doing this conversion. So is it better to close now and take maybe that 8%, create this conversion, hold it with a guaranteed profit of 10.3% for another 30 days? Well, that comes down to the individual investor. I think this is a good trade personally as it stands right now. Does it leave room for upside? No. If the actual plan for the stock or the expectation was that it might, now that it's pulled back, it might go back to that $48 or $49 range, we can't get more of that upside without adjusting the short call. Okay, but right now, both the call and the put are making money. Since it's pulled back to 46.11, the call has decreased in value for him. It's gained about 98 cents since he sold it, or since I put in that historical price, and the put's up 80 cents because the stock's pulled back. But of course, the stock's $1.40 away from the strike price at $47.50. Going on forward on this, we have to ask ourselves, well, what else is coming up? What else is involved with LNG? And what, of course, you're seeing here, we'll take a look at this in just a moment. This is the stock research tool on PowerOptions, which shows us all of the important data. We just put some of it up here, all the data that we have for the stock. Whenever you call in and ask a question about a position, or ask me what are the ramifications, or if you have a question about a structure, I'll usually go to this tool and go right in here into the middle section. Because whatever structure you have, I want to be aware of, do you have earnings coming up between now and expiration? And LNG shows it's unconfirmed, but there might be earnings around 11.6. If we're expecting a positive move, positive earnings, we might not want to be hindered by capping that upside with the short call. We may want to buy it back right now and leave the protected position in place with further upside. There's no dividend to worry about, so he doesn't have to worry about getting assigned early if the 47.5 call was in the money between now and expiration. Okay, so those are two things that I always check whenever evaluating a position for myself or for a customer, just so I have that knowledge. All right, now what else could be done? Well, we could use the portfolio tools on PowerOptions to see rollout opportunities. Even if you're just tracking a long stock, it would show you those positions. If you have an unrealized gain in a stock, you can also use the insurance tool to see how to lock in gains and maybe sell a call with higher upside, or maybe you could create a synthetic straddle or strangle with earnings coming up as well. Okay? And Sam brings up a good point. We're going to take a look at that also. So let's now navigate over to the PowerOptions suite of tools very quickly. Let's see, here we go. And I actually have to move my screen over to get a better view. Okay, so there we go. All right, so what we're looking at here, of course, is the basic trial account for PowerOptions. Those of you just getting started, I encourage you to take advantage of the 4 steps that are listed here. You have the various data pods down below, but of course, you can go through the quick start guide, flash tutorials, free webinars, and more. What I want to do right now is I'm going to go to My Portfolio, and we're going to go directly to the Portfolio tools where we track our open positions. Here, of course, I've entered in the LNG positions, just the straight stock, owning shares with a cost basis of $43.50, and the estimated prices I used for Sheldon's positions back on October 17th was selling the call for $170, buying the put for $125. Okay, so it's pulled back to $46.11 or $46.18 is where it closed. We could buy back the call for only 73 cents, realize 98 cents of profit. And of course the put's gone up to 205, so we've gained 80 cents on the put as well. We could sell it, or we could just leave the put open and buy to close the call and leave the upside. Sam's got another point on that, and we're going to take a look at it very quickly. But first, anytime you're tracking just a stock position in the portfolio, or a covered call, or a collar, any position really, even your credit spreads and debit spreads, as you're tracking the position, you can use the More Information button here on the left-hand side. We can go to Position Actions and then select Position Analysis. This is going to give us a breakdown of our current position, where we stand right now, our basic profit and loss chart. Current liquidation gain is 6.2%. Normally in an option strategy, you'd also see the comparison of your current liquidation value to the future expiration value if the stock stays at the same price. However, this is just a stock position, so we don't have an expiration value. But down below, we see that there are some opportunities shown where we could sell a covered call. Here's the call that Sheldon entered, and if we sold it right now, we'd only get that 64-cent bid and, or so forth, so we know we'd have a 10.8% return, but we wouldn't have any protection to the downside. Okay, but it shows the different strikes we could use for December and November. What would the potential return be? What is the probability of getting assigned and earning that potential return on the position? So it gives us a good gauge of comparison. What's the best one for me based on my expectations? Now down below it also shows us some hybrid collars, of buying the January puts 45 or the 47.50 and selling maybe a December 48 or 47.50 call with the new maximum returns and the maximum risks shown as well. So we could create sort of a calendar collar or hybrid collar also. So this is what's available here, and when you see the rollout opportunities, of course, you can use the more information button on the rollouts to go to Simulate Trade. And the Simulate Trade feature gives you a side-by-side comparison of the positions. Your original position in red, where you are right now, and where you might be, of course, if you enter the collar position with further upside as well. Not the best graph that came up because of the different time frames, but on your right here in blue is what the new position would look like, and you'd see it on the graph down below. The better example would be to just take one of the covered calls. Let's look at our November 47.50, pretty simple. We can go to the Simulate Trade feature for this rollout opportunity. There is our side-by-side comparison. Liquidation of 6.2% right now. The potential to make 10.8% if we just sell the November 47.5 call now, about 64 cents. And then down below we have our long stock position in red and of course the new position in blue. Now another thing I will commonly do after I look at these positions here that show me some opportunities, what I may consider doing, knowing that I have an unrealized gain in the stock, is go to the Married Put or Collar tab and click on the Insurance tool. And this tool is very simple. It just asks you to put in your symbol. We have LNG. We have a cost basis of $43.50 per share. And then it allows me to set the time frame for the buy put month and the sell call. Well, which put would I want to buy? If I know that the earnings are coming out on November 6th, I would look at November or December. So let's go ahead and select November and hit Calculate. So now what this shows us with the stock at about $46 is a variety of different puts we could buy. Remember, we have an unrealized 6.2% gain in the stock. And if we bought an in-the-money 50 put for $3.98, our cost basis would go up to $47.48 per share with the married put position. But we're guaranteed to get 50 back, so we've locked in $2.53 of our unrealized $2.68 or 5.3%. I wouldn't necessarily do this. I think it's too deep in the money, even though it gives me the best locked-in profit. And what does locked-in profit mean? That means it's a bulletproof trade. Let's take a look at the profit and loss chart from this potential position. So right now, by buying the 50 put, even if earnings come out and the stock falls to 40, we're guaranteed to make 5.3%. Sheldon's in a much better position, don't get me wrong. He's guaranteed to make 10.3% using the conversion at the 47.5 strike. But this leaves upside open. But further upside wouldn't be realized unless the stock moves above 50. That's almost an 8.5–9% gain on the underlying security. So maybe using a strike that's closer to the current price, such as the November 47.5 we saw earlier here, might not be a bad play. And we can also say, well, what combinations would exist if I went ahead and sold a November call? Can we beat that 10.3% potential return? Well, sure, we might be able to. But again, this was done when the stock was at 48. Sheldon's position was done when the stock was at 48. So we're not seeing as much gain here. But this does show you the comparison of selling 48 calls against 47 puts or 47.5 puts. Gives you the numbers and the probability right there. In general, I like to start off with just the married put part, lock in the gains that I'm expecting, especially ahead of earnings, have a guaranteed profit, and then I can do another adjustment. Speaking of other adjustments, Sam wrote in, we're talking about married puts here, but we're also talking about the radioactive trading techniques. And what Sam had mentioned is that in the current position that we have, our conversion, let's take a look at the profit and loss chart of our conversion that I entered in here for the portfolio. Sam said that we could buy a call if we expected further upside. Now we generated 45 cents of credit to help us get to this 10.3% return either direction. Of course, this is my adjustment, my prices, not exactly Sheldon's, but this is the profit and loss chart he has. If I'm expecting further upside, let's take a look at November, or I could even look at the weeklies, but let's go to standard November to keep everything the same. Now, here's an unfortunate view. What I mean by that is if we went to the weeklies, we'd have 50-cent strike differences. So I've already sold a 47.5 call. Maybe I could buy a 48 call or so forth. I don't have that in the standard expiration. Right now it's only at 250 strike differences. But if I wanted to plan for further upside, I've already got the conversion in place. And remember, we took in 45 cents of net credit. So let me use some of that to get the 50 call. And we might pay about 19 cents or so. The midpoint, is a bid of 14, ask of 24, so the midpoint 5 cents. We might buy that 50 call for 19 cents. We still keep a positive net credit. But now what happens is we only have a 9.9% guaranteed profit. But now what happens is we sort of go back to this position where you have 9.9% here, but if the stock does gap up to 52 or 53, we've got further upside. I don't like this structure because that call is still so far away. Maybe it'd be better if we use one of the 50-cent strikes instead at a different expiration. Use the 48, the 48.50, or maybe even the 49 with earnings coming up to get a different little heartbeat graph. We're going to take away from the potential profit because we're using some of the premium we collected to buy another strike. But it does leave the upside open. But, lack of a better term, is Sheldon's position a good trade? Yeah, if he matched his goals, he's okay holding it for another 28 to 29 days through standard November expiration. But if he's expecting further upside, he may want to buy a call, sort of creates a bear call spread, but in the context of owning the stock, it's really just a covered call with an extra long call that leaves the upside open. He could also just buy to close the short call now at a profit. Okay, so he wouldn't make the full 170, but if he does buy that call back now, 64 to 81 cents, a midpoint around 76 or so, roughly in that area. Well, a little bit less than that, probably 74 cents, but that's okay. And so if we buy back the 47.5 call, earn almost $1 in premium, now we've got a bulletproof position again where we're guaranteed 8.5%. Why aren't we guaranteed 10.3 now? Because we paid back into the position to buy back that call to leave the upside open. But it's still a guaranteed profit if we're wrong, with a potential for further upside if we're right and the earnings come out. Okay? So if you have a stock that has an unrealized profit, you can enter it into the portfolio tools. And after you have it entered, you can use the position actions and position analysis to see potential married puts, collars, or just covered calls to enhance your return. And you can run the comparison, side-by-side comparison through Simulate the Trade. But under the Signature Tools, the Married Put tab, and the Collar tab, you have that insurance tool where you can just plug in your stock, select your expiration, and see what locked-in profit you could have with the puts and potential premium by doing a collar with a put and call at the same time. Okay? All right. Now, twofold question comes in. I do have long collars here. One question came in from Jim, and Jim wants to know, this will go, I know that Paul asked a question, and I'm going to use this to segue into yours, Paul, even though your question is not related to the strategy. But Jim wanted to know, can you do a conversion off the bat for guaranteed profit? If the market offers it, the answer is yes. Short answer, yes, you can do conversions right off the bat to have a guaranteed profit. The long answer is it's not going to match your goals for any position. Let me show you. I have a default search created for you in a long collar. It is a long collar structure. So let me go into the search. Anytime you go into a search in a strategy, it pulls up potential trades for you. And if you scroll down below the list of trades, See here, this is a weekly collar search, looking for weekly collars 7 days out with controlled risk and still reasonable 1 to 2% return if assigned. But I have so many different ways to create a collar. If you want the put to be further out in time, the put to be in the money, the put to be out of the money, the short call to be higher than the put or lower than the put, debit collars, different months, and conversions. All right, so let's take a look here. Do we have any conversions with the default criteria? Well, I've got SLV, SPY. Looks like some of the ETFs are offering it, but you have to be very careful. Let's just take the first one. SLV is at 1608. I could sell the December 16 call for 42 cents, slightly in the money, 42-cent premium, and the 16 put is priced at 31. So I'm getting an 11-cent premium with a 16 strike, meaning that I'm guaranteed to make, it's 8 cents above 16 right now, so we're guaranteed to make 3 cents of profit, or 0.2%. It's a guaranteed profit in 42 days. So yes, this is a no-risk trade with a twist. If SLV has its dividend coming up, you'll probably get assigned early on the position and miss the dividend. Now that's okay because you're guaranteed the profit. But on the conversions, it does get a little bit tricky in that fashion because remember, you'll get assigned, but you'll still be holding the long put. Not that that makes you pay the dividend, but it is interesting. So here's the profit and loss chart of that conversion. It's a guaranteed profit of about $4, or about 0.3% for 42 days. Something tells me that's not going to match your trading plan. You're probably looking more along the lines for 1.5%, 2% return per month, not 0.3%, okay, for a 42-day trade. But they do exist, and you can try to tweak these search results to find more, but you're going to be hard-pressed to find anything with a reasonable return. On the search, in any strategy, you can customize the results here, customize the criteria to match your needs. But on the search, Paul asked a question, can you download or export the search results in a given strategy to Excel? Unfortunately, Paul, you can't. We do not have a link to download to Excel. Copying just this table becomes difficult because of the headers and the images for the more information buttons. Well, what some investors on PowerOptions will do is click the printer-friendly results. This gives you an easier format of the listed trades. They'll copy the printer-friendly version and then paste that into Excel to try to function with it that way. Okay, but we don't have a direct export to Excel from the search. Honestly, the main reason why is because in the early days, back in trading, what many investors were doing was downloading the results to Excel, of course, and then from there, posting them on blogs or posting them on other websites as their own trades and not mentioning PowerOptions. So Ernie put a stop to that and took off the export to Excel. Now, that being said, we may institute that in the near future, of course, but it would come with an agreement for all of our subscribers, and at the same time, where was I just going with that? We'd probably have to have an agreement in place. I apologize, but at the same time, if you're using Excel because you either want to customize it a different way, you want to order it a different way, and so forth. If you want to add columns or add a calculation or add a sort function that isn't already available that you're trying to do in Excel, send us an email and let us know what it is. And we'll try to manage that, and we'll try to get that in there so you don't have the need necessarily to download it to Excel. Okay, so Paul, just send me an email. We'll see if we can get what you need added into the position. All right, let me pause for a moment here. I'm going to do something real quick. I'm going to go ahead and scroll up here and scroll down. Give me one moment, folks. All right, so let's see. Sam likes the LNG trade. He thinks it's a good idea. Okay, so thank you for that, Sam. Got a question from Michael. He said, I sold a covered call that expired worthless today. Earning the stock are next week on 10/25. Should I sell another call on Monday or wait until after earnings? I do the opposite. It kind of leads into this. I didn't even see your question beforehand. Something that expired. Okay. I'm just going to use a different view. Okay, a different stock. And I don't know if it has earnings coming up or not. But let's say, let me do it this way. I track this stock. It's a position I'm in. I don't have a call open on it, but I have earnings coming up on 11/2, not 10/25. But ATVI jumped up today and it moved a little bit yesterday. But let's take a look at the stock chart very quickly. Okay, I want to make sure everyone's seeing the same thing I'm seeing. It kind of glitched there for a second. There we go. Okay. So I want to pull up big charts very quickly for ATVI. And I'm just going to go 1 month, so bear with me a second, folks. Make it easier to read. Here we go. Let's say that we got in on the 9th at around 61, and then on the 12th, let me write this down, 9th, just about 61.25, which are a little pullback. And then on the 9th, when the stock, or I'm sorry, on the 12th, when the stock breached 62, we sold the 63 call for X amount of premium. We're going to see what that is with the historical tools. Okay, so on the 9th and then on the 12th, we sold the 63 call, which expired worthless today. All right. First things first, let me go back here. Let's go to the option chain. And here's just your standard chain. I'm just going to look at the call chain to keep things simple. And what I want to do now is use the view for the historical. I want to go back to October 12th for ATVI. Look at the October 20th expiration, not the 13th, thank you. And the 63 call, not great. We'll call it 40 cents. How about that? Okay, so let's go back to our custom spread tool. Let's clear this view out. We're going to say that we bought ATVI on the 9th, 100 shares, let's keep the math simple, at 61.25. Now, when the stock moved up to the 12th, that was on the 9th, when the stock moved up on the 12th, we sold that 63 call, which expired worthless today, for 40 cents, I think I said, right? Yeah. Okay. So that's going to knock our cost basis down to 60.85. Okay. Now, if we were assigned, we would have made 3.5%. We have a cost basis of 60.85 with the stock trading at 62.63. Let's say, Michael, I'm in the same situation as you. Instead of earnings on ATVI coming up on November 2nd, earnings are coming up on October 25th. Now, this call did expire today, so my cost basis is lowered down to 60.85. Rather than sell a call, which would cap the upside. Now, I'm not saying you're going to have a Skechers result on your stock that you're currently trading. I missed that one as a straddle, an earnings straddle. It was kind of expensive, but man, a 33, almost 40% gain at some points today. That was a monster. Unbelievable. But let's go back to signature tools and let's go to insurance. I've got ATVI. My cost basis per share after my call expired today was 60.85. I'm going to look at the October expirations, assuming that earnings is coming out on 10/25 for your position. I'm not going to look at the call yet. So let's hit calculate. No results found. Only a 2.9% gain. All right, so let me go out to November. Let's see what we have there. There we go. There's some Novembers. You know what? It's probably defaulting because it's not trying to find the weeklies. No, okay, let's just stick with November. It's okay. So I see some deep in the money puts that could lock me in most of the profit. But again, what I said before, I want something that's near this stock price, maybe the 64 or the 65, and I see them here. All right, so let's take, I'm going to go for the 64 put on November 17th. I know you're there. Oh, it's not actually there. That's okay. The 62.5 doesn't give me a locked-in profit. The 65 does. We're going to use that. Okay, so November 65 put. Buy it at 398. So my cost basis goes up to 64.83, but I'm guaranteed a profit now. Okay, let's take a look at the profit and loss chart for this position. So now I'm going into earnings with a guaranteed profit of 0.3%. Not a lot. Okay, but enough that if earnings disappoint, I'm still profitable, and if earnings move up, I still have further upside. Let me take a look. I just want to see with the stock at 62.63. I don't know why the November. Oh, again, oh no, they have them. All right. I want to see what the oh no, they don't. When it got to 60, I'm sorry, it went to 2.5 strikes. Let me change to the weekly expiration. There we go. I want to use this 64 put for the shorter term. Okay, you do want to go shorter term just to protect your position and pay a cheaper cost. Now it's still 328 at midpoint, and it's still about 0.2%. Actually, the 65 in the money is a little bit better. But now, another thing I could do, which is what Sam pointed out, is I could create a bear call credit spread on top of this. I'm going to use the 10th of November expiration. And I'm going to sell the 64 call, good premium, and I'm going to buy the 68. I'm going to go wide on this one, 4 points wide. So we're going to sell this for about $1.70, $1.81. I'm going to buy the 68 call for 71 cents. So now I have a protected position that still has unlimited upside at a guaranteed profit of 1.5% because I generated about a little bit over $1.10 in premium extra to get me to that view, to help pay for the put, the time value of the put option. Okay, so this is not a bad idea. But again, what I would do is, now that your call is expired, if I just sell the call, get a great maximum percent if assigned, but if I'm wrong and the earnings disappoint and the stock falls 4 points down below 48, I'm looking at a loss. Sure, I've had some of that loss. But if I buy the put first, I could have a no-risk position with unlimited upside still available. Okay? All right. So I would look to buy the put first, especially if you have an unrealized gain on the position there, Michael, instead of selling the new call. If you want to be bold and you want to hold it without the call open through earnings and try to use a stop loss, but remember, the movement's going to happen pre or after market. So if you just leave the long stock in place and try to use a stop order, it's going to get violated if it falls too big. You won't get stopped out at your 5% stop. If it falls 20%, you get closed for the 20% loss, whatever the market's opening. Okay, so I would look to buy that put to lock in the gain, go through earnings without any risk, and then if it gaps up, now you can sell a higher strike call, let the put expire worthless, and continue the trade. But if you have an unrealized gain, go through the earnings with the put in place so you can have that locked in profit, no risk to earnings, leave the upside open. Okay, Bob wants to talk about credit spreads. Says how to exit a trade on XLV. I had sold the November 17 80 put and bought the 78. Okay, for a minimal, or net credit, excuse me, not minimal, net credit of 20 cents. Should I roll this trade or put in a closing order? Let's take a look. I don't know where XLV is. It's at 83.88. We're in the same stock, XLV. Okay, so you sold an 80 put, I'm assuming. Yeah, for a credit, so you would have had to sell the 80 put and bought the 78. And we're just going to put in prices of 30 and 10. All right, so it's the healthcare sector spider, 83.88. You're still out of the money on the position, looking for, yeah, the 11% gain on that position. Okay, what should you close it now? I don't think so. I think what you should do is that if the stock falls, our general rule on spreads, one of our management techniques, our triggers, my apologies, is if the stock reaches within 1 to 1.5% of the short option strike price, that's when you might consider to take action. So 80 strike put, if I saw the stock fall to $80.90 or $80.88, okay, then I would consider making an adjustment. What might the adjustment be? Well, if I'm within 3 to 4 days to expiration, I can probably close this for a profit because the time value is gone. If it hits that price when I still have 2 weeks to go or 3 weeks to go to expiration, well, you did a good thing in my opinion. What I like to do, you left a strike in between. So what you may be able to do, sure, is close the spread. The stock hits that trigger. You could close the spread and move down the whole spread maybe to a 78.76 for December. All right, close and roll down. Roll it down. Now, that might not always be the best choice. Why? Well, the stock you were hoping would stay above 80, but you're hoping it would stay above this level here and continue to move up. If it's at 80.88 or 80.98, that means the stock's fallen and it's moving against you. Why create another bull spread on a stock that seems to be falling? Or take a chance that there's a surprise with all the healthcare and everything going on. Okay, but the first thing you could do if your target's hit is close, and if you're close enough to expiration, realize a profit. Or if you're still far away, you could close and realize the loss. All right, but number two, you could close the position and roll down the spread. Another idea is if your sentiment has changed and you want to stay in it, you could close for loss and then create the opposite. In other words, close your bull put spread because it looks like the trend has turned and open a bear call, maybe at the 82.84 strike because now you're slightly bearish. Okay. One thing that I mentioned about liking the strikes between, if you're still a few days to expiration, a week to 10 days, and the stock hits that trigger within 1% of the short put, buy to close your short and roll just the short down. So buy to close your 80 and then sell to open a 79. Now you have a 1-point spread with more cushion. The stock would now have to continue to fall and go below 79 before you start losing on that position. Only, of course, if it's at a profit. So you'd buy to close and roll down. Not the whole spread, just roll down one strike, your short option strike. Okay? There are other things that you could do. There's about 7 different ways we discussed to manage a put trade. Well, right now, it may have dropped recently, it may have pulled back recently due to news in the market and other things. It's at 83.88. Again, I look for that 1% rule. If the stock maybe fell to $80.90 or 80.88 or somewhere in that range, then I might look to be a trigger point to perform one of the adjustments. If you don't know what adjustments are best, well, there is no best one, in my opinion. Okay? It depends on what the market is offering you and how close you are to expiration, but we do have guidance for you. As always, if you go to our free webinars page, this is a public page. You don't have to be logged in to access this page. You can just go to poweropt.com/webinars.asp. Okay? And you have webinars on the Power Options tools, option strategies, various concepts, and requested topics, where our Friday discussions are archived. Click on Option Strategies. There's a webinar here on managing your spread positions, our preferred 7 ways to manage credit or debit spreads, the pros and cons of when to use them, and more. Further down, there's a whole list of webinars here. There's one on just managing your bear call credits. There is one way down here. I thought there was. Okay, managing your vertical spread is in there too. Okay, I thought there was one on just bull puts, but you can look at the managing your spread positions, the different 7 ways to look to manage a spread that moved against you. We also discuss our trigger points for a bull or, bear spread. There are other trigger points we might use. You know, when I originally open a bull put spread, I'd probably be using technical indicators of a stock being above a 20 or 50-day moving average. Well, if I see that change, or there's a MACD crossover to the negative, that might be a trigger point for me, even though it hasn't dropped to the 1 or 1.5% range on the position yet. Okay, so that's something that you might want to consider as well. Let's just take a look at that. Okay, all right. Let's see here. So, oh, sorry, I'm looking at the last, scrolling down here for the views. Okay, all right, Bob, you're welcome. Okay. Sam had offered some comments here. I was just trying to stick through them. Yeah, Sam was talking about maybe buying back the short option and buying another put. He sees I'm sorry, what is it there? I'm sorry, a support at 77.62. So if he's saying if it starts to break, you might want to consider buying and close your short option and buying an extra put to see how it would still go down in price, okay? All right. Where is... I apologize. Let me go back a little bit here. There we go. Related to this question, we've got several other questions coming. I'm going to get to them in just a moment, okay? But Rajiv says, if XLV gapped down 4 to 5%, then how to manage? Okay, so if this dropped down 5% or $4 and was trading at 79 between the strike prices, and we've talked about this before on the other webinars. Let's say it gaps down suddenly, it's trading right at 79. Again, I'd follow those same 7 rules. Okay, those same 7 adjustments. Number 1, close and take a loss. If I can't figure out where the stock is going and I have no expectations for after this unexpected gap, why try to manage it to the upside to create another bull spread or the downside to create another bear spread if you don't know where the stock is going? Sometimes maybe just close, take the loss, don't try to overtrade it. Okay, number 2, you could close it for a loss, and then I'd probably have to roll out to, let's say, December, maybe even January. So I close and maybe roll down again with the stock at 79, let's say a 77.75 spread, but out to January to try to cover the loss on the position. So close for a loss, roll down, and this is for a bull put, roll down and out. Lower strike prices further out in time to try to cover the loss you took. All right, so if it gaps down, I won't reach the full 180, but I might have a loss in the position of $1.20 or $1.30. So I'd have to go out and find a credit now on a bull put that's offering me at least $1.20. That might be out to January. Case 3, I could close and do the opposite. Right? So I'm thinking it's bearish now after the gap down. It's between the strikes. I could close and do the opposite, create the bear call if I'm now bearish. An advantage with this one, now it's, so we're saying it drops down 4 points, goes to 79. I could do that other one where I just roll down 1 strike because he thankfully left 2 between, which is what I always do. I always leave a strike between for this adjustment. But close the 80. I'm sorry. Buy to close the 80, sell the 79 if you think it's going to recover. Now you just rolled 1 option. You're still in a bull put credit spread. You still might have a small profit if it stays above 79, if that's your expectation, okay? So there's 4. Number 5, I'm not one to really do this, but it depends. Let's say it gaps down, Rajiv, Monday or Tuesday by 4.5%, and we still have 24 days to go to November expiration. You may just buy the short. Okay, if you think the stock's going to continue down, buy to close the short, leave the long open. Now you've got a long put. Okay, you took in 20 cents initially. Maybe you had to buy that one back for $1.60. So essentially now you're holding a 78 put with a cost basis of about $1.60. Okay, it might not be the best position, but if it's changed and you think it's still bearish, buy to close the short, leave a long put. Your cost basis is the total cost in the position. My favorite to do in this situation would be the pendulum adjustment. Okay, and what is the pendulum adjustment? That means that what I would do here, we talked about closing and creating the opposite. So closing out both legs and then opening 2 whole new legs for a bear call credit spread. Well, I can turn this bull spread into a bear spread with 1 move. What I can do is simply sell to close the 78 put, now that the stock has dropped to 79, and buy to open the 82. If the premium is there, if the cost to buy back minus the initial net credit I received is less than the new difference in strike prices of 2 points, I now have a bear put debit spread. But by rolling 1 option, I've created a bear put debit spread where if the stock stays below 80, I'd make full profit on the bear put. We call that the pendulum adjustment. It's also shown in that webinar as well. Okay, and you're saying, of course, also, Rajiv, well, if it gaps down below to 79, it goes between the strikes, you think it's an overreaction and it starts to recover, when to take action? Well, there's no one answer to that. It depends on the severity of the drop initially, and then, of course, how it could come back up in price. How fast does it come back up in price? How much time do you have left for expiration? Okay, and XLV different, a little bit different, but if I'm in a standard stock and it goes below my short put strike price, and I've got 2 weeks to expiration, but dividends or earnings are coming up within that 2 weeks to expiration, I'm probably adjusting this one way. See, if the ex-dividend date is coming up and the stock's below my short put, I might get assigned early, which means now I'm short stock and I have to pay the dividend. I don't want that. Okay, I'm sorry. No, yeah, that wouldn't really happen. I'd end up buying stock in that case if I was assigned early, which doesn't make a lot of sense because the person would want to hold it for the dividend. Sorry, I'm thinking bear call credit discussion I was having earlier today. So, you know, and the market is volatile, but there's no one answer, I'm sorry, to your question, Rajiv. I approach every position with a trading plan. If it reaches within 1% of my short put strike price, I'm going to look to adjust it. If it gaps between the strike prices at that time, I'm going to evaluate those 4 or 5 roles I just mentioned. The pendulum adjustment would usually be my first, but I'm going to look at why the stock fell. Is it an overreaction to some event? Is it my sentiment's changed and I'm bearish? Then yeah, I'd probably use the pendulum adjustment or a different one. That's likely. I'm not a fan, as I mentioned, of just rolling the bull put spread down to lower strikes and further out in time because I was wrong on the direction of the stock in the first case. I don't want to try to catch the falling knife and keep having to roll this bull spread if it keeps going down and down and down. Sam says, could you put a stop on your short leg? Yes, but remember the stop only works if it's hit in market conditions during regular market hours. If it gaps down, if I put my stop here at the 1%, or that's my trigger to do an adjustment, or if the stock hits 80, if it spontaneously gaps down 4 points and is trading at 79, I'm going to pay much more. I'll still get triggered, but I'm going to pay much more than I would have if it had hit my 1% trigger during market hours. And that's the problem with a stop. What if it gaps down to 76 and then later that day comes back up to 79.80? They would have closed it for me when the stock was trading at 76. I would have paid a lot to buy back that short put. The stops on the options are just as dangerous as stops on a stock in the pre or the aftermarket hours. Okay, they can come back to haunt you very, very quickly, or get you closed out more often than you thought. Okay. Yeah, Sam says he was also in Adobe and Johnson & Johnson, and after the earnings he bought calls after the retracement, and they both opened well today. And and X, so of course Steel as well. So Sam has a play that he usually waits till after the earnings instead of playing into earnings events, looking at straddles or strangles or so forth. Instead of playing into the earnings with high costs or taking the risk of selling straddles and strangles and getting those violated by an unexpected move where you realize significant loss because you just really had a naked put or naked call. Long straddles are the way to go, but they get really expensive. What Sam does is wait till after the earnings and then decides, stock pulls down, thinks it's an overreaction. Well, you can buy calls, and then as it moves back up, as the open we saw today on most stocks was pretty good. Okay. Okay. Paul had another question that came in regarding the portfolio. And what I'm going to do, Paul, is show the adjustments. Paul said, in all your trade analysis, you have built in the various trade costs. If so, where do we do this? I'm assuming what you're talking about is when I was talking about the lowering cost basis on the ATVI position and so forth. Okay. So let's enter ATVI into the portfolio. Now, what we were talking about was doing a covered call. And I would have entered in the portfolio. I bought 100 shares at 61.25 on October 9th. I'm sorry, and then I can put my commission fees in as well. I have $4.95 for the stock. Okay. Then later, oops, I'm sorry. That's better. All right, so now let's enter in our covered call. We had sold today's, what did I say, 63 call for 40 cents. And that was on the 12th. Okay, so there's my covered call entry into the portfolio. Let's submit that. And another advantage of the PowerOptions tools is we organize by strategy. So here's my collar, here's my covered call. If I entered more covered calls, it'd show me I have 5 covered calls that would all be linked together. It's easier to see than a lot of old school brokerage houses like Fidelity that just show you the calls, the puts, the stocks, and it's order an entry, so you don't really see it as a covered call or married put or collar, for example, or bull put credit spread even. Now, I'm not talking about TOS or Interactive Brokers. They show it correctly. Okay, but what happened today? Here's my cost basis at 61.25. I'd sold that 63 call. It expired. Well, as I'm tracking a position in the portfolio, I'll go to Position Actions and Expire Leg. So this just shows me that we're expiring the October 20th 63 call that we had originally sold for 40 cents. No commission cost is going to be added. Okay, so now what am I left with? I'm left with 100 shares of Activision with an effective cost per share of 60.85. So Paul, as I'm tracking them in the portfolio and I make adjustments on the options on a stock position, it'll count the gains or losses that we've taken to adjust the effective cost per share. So now when I go to the position analysis view, it shows me the total cost is 60.90. Oh wait, that's wrong. It should be 60.85. It's taking into account the $4.95 commission that I paid for the stock. Okay, so all of the adjustments as I start rolling, selling calls, buying puts, doing other things, as I track it in the portfolio against the stock, it's going to continually adjust my effective cost per share. So 60.85 after the 40 cents expired worthless, and $4.95 for the stock commissions. And so now my rollout opportunities of selling a new call further out in time, you know, the stock at around 62 or so, 62.50, and the new percent if assigned is based on my effective cost per share on the stock, as is the locked-in profit for the collars or the married puts. It's all based on that as I'm tracking it into the portfolio. Okay, but when I went to the insurance tool, you know, here I know what my price is, so I would have used the effective cost per share to enter that into the portfolio. I'm sorry, into the insurance tool. And if I buy to close this call as Sheldon is thinking about taking in some of that gain, my effective cost per share would lower by about that dollar price to go down to 42.53 or so. And then when I look at the position analysis or the profit and loss chart, it's going to use my effective cost per share on the position. Okay, so that's how we calculate that as well. Okay, so you said you meant all the broker fees and commissions so that we get an accurate result. Okay, well, all my positions I track in the portfolio, I'm just showing them for an example without the money, the commissions in there to keep it simple. But yeah, all of my positions that I enter that I'm tracking for my radioactive trades, my calendar spreads, credit spreads, straddles that I'm using, and collars, I include the commission fee. So this effective cost per share, when I go to the position analysis, it grabs that, but it also grabs all of the commissions that I've paid also. I include that when I open the position, close a position, roll a position. Those are all included as well. Okay. All right. Okay, let's see what we've got here. Sam had mentioned that he was doing a PayPal position also where he was in sort of a married put position, but he rolled the put down when the stock moved. He had 100 shares of stocks and puts at 72.5, and then bought it later at 70 to close. It's almost 71. So he sort of averaged down with the married put in place. So we controlled the risk originally and then moved forward. Rajiv says, I tried selling naked puts on U.S. Steel 2 weeks back when the price was at $25.40 and the 26 strike for $1.25. And the stock has moved up a lot and you bought back the short put. Okay, how to buy U.S. Steel now? Get it from market or sold another naked put. Get into the stock and buy the double put, one below and above current pricing 1 day prior to earnings. Okay. I'm sorry, you said 40 cents? 40 to 5 cents. Oh, $1.25. So you've got $1.20 effective gain. You sold your 26 strike put on U.S. Steel for $1.25. You bought it back for 5 cents as the stock moved up. Okay, so X right now, let's go to the stock tool, is at 28.43. And earnings are on 10/31 confirmed. Okay, but keep in mind, you generated $1.20. So if you bought the stock right now at 28.43, your effective cost per share on the position would be 26.89. Did I do that right? Probably not. Okay, but let's go in here. So we got the married put. We'll go to insurance. You might buy the stock at 28.43. Oh, I'm sorry. Yeah, you had a realized profit of 120. I did that wrong. So your cost basis is 27.23. Again, you could use this position, the insurance tool. Your cost would be 27.23. Go out to November with earnings coming out on October 31st. You've got a 4.4% unrealized gain. You could lock in some of the profit, and again, I'd probably focus on the 29.50. It'd guarantee you a profit of 0.4% or so. The 30 is also at about 0.4%. Oh, the November 17 standard, 0.6%. Or you could go deeper to the 30 puts at 1.1%. Okay, I'm not going to tell you which one to trade. Let's just look at the, I don't want the 31. Let's look at the November 30 with the stock at 28.43. So here you'd have your locked-in profit, only $18, okay? Now, Rajiv, all I'm going to say to you is, you know you've got a $1.20 guaranteed profit. If you're still neutral to bullish on this position and you want to get in the stock, you know the earnings are coming out on the 31st. You could go out to the 27th, maybe sell a 28 put for 39 cents, maybe 27.50. So if you get put the stock, you've got the $1.20 realized gain with an extra 20 or 25 cents. But if it doesn't fall below the put strike price on the 27th and you don't get put the stock before the earnings, then you could just buy the stock outright. You know, buy to close this for a cheaper price and do that. You've got an extra week between before the earnings, it looks like, so you could go another naked put with the premium, or you could buy the stock now and you've got a $1.20 realized profit. You could lock in the profit, not a lot, I know, but only $18, 0.6% with the put, but maybe you still could also do that sell a call, buy a call, what we call the income method number 6, to leave the upside open going through earnings and generate more premium against it, okay? Oh, I'm sorry, Sheldon. Sheldon brought up another point. Real quick here. So you could still do that bear call spread, that income method number 6. With earnings coming out on the 31st, what I see, you could sell another put for the 27th, sell it on Monday, get a little bit more premium, maybe have the stock put to you, and then you could protect it. Or you could just buy the stock now. You know you've got a $1.20 realized profit, a realized profit in the position to lower your cost basis and buy the put. Going back to the portfolio, Sheldon brings up an interesting point, something I want to clear up. I showed the ATVI example where I sold the call for 40 cents, it expired, and we lowered our effective cost per share, what will now show up in the analysis, including any commission cost. Sheldon says that his effective cost per share in his portfolio, the 43.50, has not changed, even though he sold a call and he bought a put. You're right. And the reason why is it's not that it's finished, it's that it's not realized. You did collect $1.70 into the position. You did pay $1.25 out, but the effective cost per share will not adjust until this expires or you buy to close it. If I buy to close that call right now, okay, when it's closed, that profit is realized. Okay, so you originally sold it for $1.70. We're going to just, to keep the math simple, we're going to buy to close this call today. We're going to close leg, not the whole position. I'm just going to close the short leg I linked from, my short call. I'm going to buy it back for 70 cents. I know it's not realistic. I'd have to pay closer to 80, but to just say that we generated $1 to keep the math simple. Okay, so today we closed this for 70 cents, got $1 profit. Now I'm in a married put. See, the system knew that now you're still in a married put. We closed out the collar, and your cost basis dropped to $42.50. It won't lower the cost basis on the portfolio by $1.70 when you sell the call, because you might pay $3 to buy it back, meaning you actually have a loss of $1.30 that needs to be added to the cost basis. Okay, so it's only going to do it for closed positions. That's what will change the effective cost per share and show up in the history once you've closed it or it expires. Because I haven't realized the $1.70 profit yet. I only realize part of that $1.70 profit when I buy to close the position or it expires. So once you start closing it and rolling it, then you'll see your effective cost per share for all your closed positions. And in addition to that, well, you say if you rolled it or you bought to close it, the original call is no longer showing up in the portfolio. Where do you see it? You can see it in the transactions. You can look to view all positions. It gives you a running total of the realized gain or losses. There's my 40-cent expired ATVI call. There's my dollar gain on the November 47.5 call for LNG. Only when it's closed will that adjust the effective cost per share. My favorite view to analyze closed positions is the analysis. This shows me my open legs highlighted in red and my closed legs, of course, with the white background, so I can see the running tab of my entire position. As I roll calls, buy calls, sell calls, and more, we get a running total here of the entire gain and loss for the position, for the stock itself, no matter how many calls I sold or did or anything along the lines like that. Sam offers the thought, which is what you did originally. He says if you want to buy X, sell the put in the money if you want to buy before earnings. Okay, so he's saying with the October 27th series, you might want to sell the 30 strike put, which is what you tried the first time and it moved past that. So you've got a $1.20 profit. That, of course, is another approach. I think that's what Rajiv started at first, Sam, and it just moved by it to go against it. Okay, yeah, and if you want to, Sam also added the same thing I said. If you want to get the stock put to you and then hold it through earnings, Rajiv would buy a put. He knows that once he gets the stock put to him or he buys it outright, he's going to buy a put through earnings to avoid that case. Maybe you could even create a synthetic straddle or strangle by buying two puts with a shorter term expiration to give you that V profit and loss chart where you can profit to the downside or the upside. What do I mean by that? Entering in a ratio. So we'll take X again. We're going to buy 100 shares here with our cost basis. What was it, 27.23? Yeah, 27.23. We know, let's say that I bought it. We know that the earnings is October 31st, so I might go to November 3rd. And 27.23, not quite no risk, but I might buy the 28 puts, but I buy two. So I have 100 shares and I'm buying two puts, which is going to increase my cost basis, $1.14 for both, so I'm adding $2.18. But now in the worst case scenario, if the stock doesn't move at earnings, I lose $1.50. If it drops below 26.50, I still think that's too wide. I'd like to see a little bit better view here, a little bit tighter upper and lower break even if possible. But yeah, you can buy two puts. You've got the long stock. You create a synthetic straddle in this case where if there's a large gap up, you can still profit to the upside, still profit to the downside. You're not doing too bad if it's right in the middle, and you could still manage it further based on the values of the puts. Okay, it was something that a customer asked if I was going to do with my married put picture there. Yeah, it says better buy a day before, get the best put price. Yeah, it's questionable because the implied volatility might be increased, but you're right. If I went in now and bought the stock for my price of $27.23 with your $1.20 and then bought the two puts, well, buying them today, we'll buy the 27th, the stock would be at 30. You know, it could still continue up and be at 30, so I haven't protected it yet going into, I've had it protected to earnings, but now I got to consider rolling these puts to get a better price. So yeah, it could be okay to wait to before earnings, but then remember the implied volatilities are going to be inflated because everyone knows earnings are coming up in 24 to 12 hours. Okay. I don't have it here, but I had a married put on CFG where I think my cost basis on the stock is about 36.11. And I'm holding a January 40 put with a cost basis, I think, of 510 after some adjustments. Yeah, that looks about right. Well, the earnings came out today, and you know, it was trading at about 36.80, 37.20 yesterday. Yeah, 37.20, and it jumped up $1.40 at one point. But yesterday, someone said, "Well, you're going to add an extra put to create an income method number 12 for a straddle," and I didn't because I was actually bullish on this. So I let it move up to 38.33. Now I'm considering doing an adjustment of moving the put closer in, but I'm actually waiting till Monday, because what I might do is sell to close this put now, 2.8 or 2.75, and then buy a November 35 or 40 put at a lower cost. Numbers didn't look as good as I wanted. That's why I'm waiting till Monday. We'll sell to close this and buy to close the closer in one at about 215, because on Monday the December puts will be available. They're not now, but they will be. See, now I can take this to a risk of only 1.5% and $61 by making this roll to the shorter term. And then, not there yet, but I might be able to sell the November 40 call, but I need it to be at 61 cents in order to do that, to create that collar. Okay? All right. All right, the one last question here. Rajiv says, how to find ETFs, say gold SLV, for naked puts 52 to 69 days in the future with the current IV greater than the average IV. Okay, so we're looking for naked puts on indexes and ETFs mainly. All right, so I'm going to go to naked put. We're going to go to the search. Rajiv has a very specific requirement. Very specific. So what I'm going to do is just scroll down from the positions. Here's our weekly puts of the day. Hey, look, there's ATVI. Let me go ahead and clear the filters. Now, Rajiv wants to see positions that are 52 to 69 days out in time. And he wants the average IV, the current IV, to be above the average IV. Well, there's two ways that I'll do that. First, I know what you're looking for. You're sort of looking for that IV rank, but you might want to look for the IV-HV ratio of greater than 1, where the option's implied volatility is above the stock volatility as well. And the percent implied volatility range is not really what you're looking for, but what it's showing me is where is the option's implied volatility now compared to where it has been over the life of the option. Okay, so not an average, but it kind of is, because it's saying where is the option's implied volatility right now compared to where it has been over the life of the option. Well, if you want to look for ones that are higher than the mean or higher than the average, in a sense, I might look for percent implied volatility range of greater than 50 or greater than 60. I'll start with greater than 60. Okay, now I'll go to lists. And I can choose in the list to look specifically against indexes and ETFs, and then you can filter index out later. But if you just want to look for the common ETFs that you're mentioning, SPY, GLD, SLV, why don't you just create your own personal ETF list? So click on Create, Modify Stock Lists. Now I have some close to that already created, ETFs to remove, and so forth, the 2 times and 3 X's, but I can just quickly create a list. I'll call it My ETFs to View, and let's put in our symbols, SPY, GLD, SLV. I'll even put IWM. Oh, sorry. WM, maybe QQQ, anything else you can think of that you wanted to put in, you could just add that as well. So I'm just going to put in these 4. Let's go ahead and click on Create. Okay, so now we've got that list added. My 4 ETFs is probably the same, but we put it, My ETFs to View, I'm sorry, put it in 5. Okay, so now that I've created this list, let's just close the window. Still looking at that time frame. Sorry. Still with that implied volatility and the IV-HV ratio greater than 1, go to Lists, include My ETFs to View, and submit. Now, one thing that's missing from all this is any further restriction of do you want to be in the money, out of the money, minimum premium. So you can customize that further. You'll probably want to, because you've got things all over the place here, good option premiums, all the way out to December and more. Okay, but you could say that, you know, if you want it to be just a no more than, let's say, 2 strikes in or no more than 2 strikes out. I could use the strikes blank to 2 and blank to 2 to filter that. And let's say a minimum yield of at least 1.5 and a minimum premium, I just missed it, option bid price of at least 0.30. Okay, so narrow that down a little bit more. Oh, sorry, let's put that back at 1. Oh, I don't know why that filtered it out. I'm sorry. It can't be the option bid. We had 289 results there, so it doesn't like this field. I apologize. I don't know why that's not working. Let's go back just the basics. We had so many results. What happened? That naked yield was, we were well within that range. Anyway. Oh, no, we weren't. I'm sorry. These are all 0.3 and 0.9 as the highest. I'm sorry. My fault entirely. It's that 1% yield that was killing us. So I could still do this 2 strikes and 2 strikes in or out of the money with a 20-cent bid price. I don't like that 20-cent bid price. Okay. I apologize. I don't know what's going on with that. Well, I'm just going to stop doing it. All right, so there's your starting point, and you can further filter it from there. Okay, yeah, you can put DIA in there also. Okay, you want to be at least 3 strikes out of the money? No problem. Here's your full list. So I could do it by strikes or percentage. I'm going to tell the system I want to be at least 3 strikes out of the range there. Okay. There we go. So now you've narrowed it down to 52 total results, and we could put DIA into that list just by customizing it. It's real simple. Clear the results, your expiration time frame, implied volatility range of greater than 60, IV over HV of greater than 1. 3 strikes out of the money, I just threw in the minimum bid price. Create your own list. With 5 or 6 clicks, you've narrowed the total universe down to 52 trades on your desired ETF spanning all expirations, not just standard, but any weeklies for November or December will also appear in this list. Oh, no, they won't. I'm sorry. They will if they're there, but there aren't any because it's right at 56 days out in time for the standard expiration. November, of course, is 28 days out in time. So, you know, if I shorten this to be 30 to 69, which you didn't want to do, and I don't blame you. Yeah, see, now we've got November weeklies, 3rd week, 4th week, 5th week, December 1st, and so forth, okay? So, yeah, but you're 52 to 69, straight in, narrowed it down. A couple criteria, that 3 strikes out of the money or more. Again, you can do it by number of strikes in each strategy or by percentage. Just put in your requirement, you're all set. Didn't have that 1% naked yield. That was my fault. I was looking at the wrong column. I was looking at the IV-HV ratio and thought all these had a 1.6, 1.7% yield as well. All right. So Sam had mentioned that based on the volume, percentage volume, and volatility, his estimation is that U.S. steel looks like a 3% move one direction or the other, but he's not really sure which direction, of course. Okay. Great. Okay, so I just wanted to, let's see here, remind everyone, of course, here we go. If you haven't done so already, there we go. If you haven't done so already, remember you can start your trial to PowerOptions. Just go to powerop.com and you'll see a field there for first name, last name, and email address. That's all the information you need to take the full 14-day free trial. That's the site I was using today. I was logged into the webinar account. That's a 14-day free trial. So all of the tools, all the strategies are available to you. Custom spread tool, portfolio, signature tools, the insurance tool, the long option finder, those are all available in the trial. Don't need any credit card information. You can test out the tools for 14 days. After that, of course, our different subscription levels start at $40 per month with the end of day service, the lower subscription. The 20-minute delayed service gives you a little bit more access to what we call the picks of the day. Those are $60 per month, and we do offer real time as well. I showed you a little bit on the historical tools today, just going back a couple of weeks to see the prices. You can do historical searches in the given strategies, historical search by symbols, and view historical chains if you upgrade, let's say, from the 20-minute delayed to the historical service. And our historical data goes back to April of 2006. So we've got over 11 years of historical data that you can test on and you can do different information on as well. So that's an upgrade from the 20-minute delayed, and then you can upgrade from the real time to that also. Okay. All right. Now, if you want other free stuff, remember check out the blog, part 1, 2, and part 3 of our stock or portfolio insurance series. Part 3 should be available soon, hopefully by Monday. So you can check out our blog for other free information. As mentioned, you can go to that webinars page, that link I sent to you, powerup.com/webinars.asp, a completely public page. Don't need to be logged in or even be a subscriber, and you can go through the different archived webinars. You can also visit our YouTube channel at any time, too, to see most of the presentations. Today's presentation was recorded. I will have it posted most likely on Monday in that requested topics section of the webinars page. We'll send you an email when it is available as well. Now, if you think of any questions later on that you didn't get to ask today, just remember you can send us an email at any time to support@powerup.com and support@radioactivetrading.com. Remember, you can also call us during market hours at 302-992-7971. And remember, those of you that are on a trial, if you do sign up for that trial, or you're a subscriber to Power Options, you can schedule one of those coaching sessions at any time. And of course, we'll go ahead and go through this coaching session. Essentially, Ernie and I will spend 35 to 45 minutes on the phone with you, walking through the tools on the site, answering your questions as well. All right. Well, ladies and gentlemen, have a fantastic weekend. I hope to see you all soon next week for some of our upcoming webinars. I'll let you know when those are available. You'll see via email what webinars we're going to have next week. We will be back next Friday on the 27th for another open forum discussion. I look forward to seeing Sam there, as well as Rajiv and all of our others, Sheldon, and of course Jim. Bob had come in, and everyone else, of course, come in. Sam just added an extra thought. He said he's in UVXY. I always say that wrong. It's sort of that volatility one there. Long put out to March. I bought the put for $7, and now it's about 18, and the stock is down 50%. Very, very nice. The price was 30. I think it might go to 10 the way the earnings are going. Okay, UVXY, yeah. So it might see a little bit of break there. It might see a little bit more. And that great surprise today that I didn't get was on Skechers. I would have loved to have had that. Well, and you bought it when UVXY was at 34. Fantastic. And you had that Netflix trade we talked about briefly. You had sort of an iron condor, and they added the extra put, and that worked well for you today also. A lot of mixing different things, a lot of different things available. So very good. I hope everyone has a great, relaxing weekend again. I hope you have a profitable trading week next week. We'll see you Friday, if not before, at one of our other scheduled live webinars coming up as we head into November of 2017. Take care, everyone. Good night.